Hey guys, and welcome back to another video on the Vertex Investing channel. Today I'm going to go through hedge trading and everything that you need to know about hedge trading, how it works, how you can do it in your own strategies, and the pros and cons to actually doing hedging. So I know it's been a while since we've posted a video on Vertex Investing. Honestly, we're just struggling for content. We are going to do more generic things like hedge trading. We're going to bring up generic podcast, topics, and we're going to go through these, but we are trying to keep it SMC based, but there is only so much we can show without giving away everything that we teach in our community, and it would be unfair for those who have paid for our time and the actual course in depth if we go ahead and do everything on YouTube. But we are going to try and branch out to more of a basics audience and a generic trading audience, and maybe even some more psychology stuff. But let us know in the comments down below exactly what you think we should cover next and what you want us to do. Without further ado, let's get into hedge trading. So what is hedging? So if you're not unaware of what hedging is or hedge trading is, it's essentially buying and selling the same pair, whether this be euro US dollar. Same for commodities, XAU, USD, gold, Ripple, US 30 indexes, all of that sort of stuff. It works no matter what. It is essentially just buying and selling the same asset class simultaneously. This means having two positions open at once, aiming for opposite directions. So you'd be in a buy position and then you would enter a sell position. Now you don't do these at the same time, otherwise you are guaranteed a loss. But I am going to explain how this works and ways that you can implement it yourself. So moving on, what's the point? If you ever get in a hedge trade successfully, you're basically in a position where you can't lose. I know this sounds stupid because you've got two trades going opposite directions and price can only move one way at once. So think about this. If you were in a buy profitably, say by 100 pips, and at 100 pips you saw a resistance zone. I'm just going to keep this as simple as possible without bringing any strategy in. Everyone's heard of support and resistance. So if your price was coming to a resistance zone and you were 100 pips in profit and you took a sell and price started to pull back from this resistance zone, and then you managed to get 20 pips in profit in the sell, but your buy is only 80 pips in profit. Now in total, based off pips alone, considering you were still using the same percentage size, well in this case lot size, those plus 100 pips are still net profit. You've got 20 in the sell and 80 in the buy. If you didn't enter the sell, you would only have 80 pips profit in the buy. So technically at this point, if you manage to move your sell to break even, then you would be risk free. I'm going to show examples of this on TradingView, so don't worry if you're a little bit confused, but both trades are at break even. Whichever the trade goes, you will be locked in at the profit. So say, for example, your buy trade came all the way back down to break even, and instead of getting zero, you'd actually be getting the sell profit. So you'd still be 100 pips up, give or take a few pips based off your entry and all of that stuff. As one loses, the other gains. This may seem pointless at first, but let's go in depth and have a little think about it. So here's an example here. We were in a buy, say we entered here, and at this point the buy is at £500 in profit, and we decide to enter a sell just to make sure, just to enter a hedge here. Again, there's nothing going on with the strategy. It's not a strategy. I've literally just put it on a chart just for an example. So yeah, at this point here, when price came all the way down, our sell was at £350 and our buy was at £100. So instead of losing £400 profit from here to here, we managed to get a later entry just slightly. It wasn't exactly where price reversed, but being realistic here, this is where you would have entered, and our sell is at 350. So now you're on £450 profit still. You're £50 short, but it's better than being £400 short. Now at this point here, price comes back up, your buy's at £350 and your sell's only at £100 now, but you still have £450 profit. We obviously entered the buy first here, so our overall bias has got to be a buy unless it was counter trend. But again, always try and trade with the trend. Your trend is your friend. So at this point here, our sell would have been break even straight away, trying to lock in those profits. So regardless of what happens to price now, if price starts to just fly up, we'll see if if I can. Okay, no, I can't. But if price sort of flew all the way up here, I will show this on TradingView again and it'll be more detailed. If price flew up, we'd be stopped out of break even, and say our take profit was here, price would have eventually hit our take profit. In this scenario, hedging didn't really do a lot for us, but it can really help the psychology because, you know, no matter what happens, you're gonna win. But you have to be a successful, profitable trader to get into hedging in the first place. Otherwise, it's very risky and I don't recommend doing it. But if price came the other way and came all the way past our break-even point on the buy, at this point, you have two options. You can either close the sell or you can continue to hold. In this scenario, I would close the sell because our bias was bullish, but we managed to get a hedge trade in. But at this point, it's at break-even. We still would cash, you know, let's say on an estimate £400 here, rather than losing the entire £500 profit that we had. So hopefully this sort of develops a little picture in your head of how hedging can actually work. So how do we do it? As I just said, hedging is not a beginner concept, and if you're not already profitable or at least confident in your strategy, then you should not attempt hedging at all. You've got to have a profitable running trade in one direction before you start trying to hedge, and I mean significant profit. It can't just be going from, you know, 10 pips up and then you decide to sell and then you've got buy and sells all over the place and then you're literally losing double the money. And if performed in this manner incorrectly, it is highly risky and can end up doubling your losses rather than making it risk free, and it becomes gambling to a much higher degree than just placing a buy or a sell. So works best with precision based trading, but it does work with all concepts. It just is, the faster you can go break even when hedging, the better. So again, if you're only using 5 pip stop losses, say price moves to a 1 to 2 and 10 pips up, you're good to go break even, and from there, you know, you're safer in terms of risk free, and allows you to lock in your profit. Okay, so we're over here on TradingView looking at the gold chart currently on the 30-minute. Again, I'm not going to put too much strategy into this. I'm just going to develop the concept of hedging in your mind. So for example, let's say we were in a buy at some point. Let's say, just for example's sake, let's say we were buying here. That was our stop loss. Our take profit was way up there, you know, whatever, on the 4-hour time frame, blah blah blah. Let's just put it there for example. So we go on the 30-minute and we see this sort of short-term reversal on our 30-minute, and we see an opportunity to sell. At this point, we could sell, let's say we got our entry, you know, well, in this scenario, just here. Again, just completely for demonstration purposes. So in this point, our buy is at break even, okay? So this is already risk-free. But if price was coming all the way down to here, there's no point in losing, say, £5,000 profit up here, all the way down to, it doesn't quite hit break even, it still could, but there's no point losing that entire £5,000 profit all the way down to here where you're at 100. Whereas if you entered this sell, practically, what's the difference between entry and the high point? 36 pips. So if you were 36 pips difference, again, let's, for example, say there's £500 in this scenario. Yeah, so you'd be up 5,000 here at the high point. Let's just write 5,000. And at this point here, you were up, let's say, 4,500. So in this example, if price did come down to here and it stopped you out at break even, again, as I said, our bias would have been bullish, as we can see here. So you would have closed this £4,500, right? Instead of losing the entire £5,000 profit, you would be up £500. And this concept is extremely good, especially if price came all the way up. In this scenario, we weren't stopped out, and this is at break even as well now. Let me just get off this. So this is at break even as well, and if price continues all the way up, at this point you're not worried because you've already locked in profits, okay? So psychologically you're good, and for God's sake, psychologically you're good. And again, both are risk-free. No matter what happens, you're going to secure at least £4,500 in this scenario. Unless price moves sideways for, you know, a good few days, you're going to lose quite a bit in commissions. But that is not the point of this video. If price did come up, like I've drawn right here, and then it continued to do this, then at this point, you're glad you held your buy, but on the off chance that price continued to drop, you did keep your sell in place and you were able to lock in some profits. So in short, hedging is basically a way to never lose, as long as you can get 2 successful trades in bullish and bearish consecutively. And hopefully this sort of explains it a little bit more. We're going to go into a little bit more detail as to rules in terms of what you should do, but let me tell you what you shouldn't do. So if you didn't lock in this and you didn't lock in this, no matter what happens, if price hits your break even here, I mean your stop loss here, and then hits your stop loss here, you're literally going to be double in the loss. So if you're not in significant profit and you, for example, let's say you buy here and that's it, and you know, you see this sort of come down here and you sell here, price instantly stops you out, and then this sell is just minus 1%. You don't want to lose 1% of your profit. Again, it is a small hit to take. Say this was, well, at this point here, we're probably 1 to 2.6. So, you know, we're still 1.6% in profit, but there's no point in losing this 1% unless you're highly certain on a bearish trade. In this scenario, you would have lost 1% here, and eventually all these profits here would disappear. So if you're not really comfortable and confident in your strategy and confident in which direction price is going to go, you really don't want to be taking hedging at all, because in the scenario you'd be losing 2%. If you're risking 2%, then you're losing 4% of your account in, you know, a very short period of time. Where does price stop this one out? Let's see here. So it's like 13 hours, you lose 4% in 2 trades, and this is on the 30-minute chart. It could be even lower time frame. So again, make sure you only really ever use hedging on the high time frame. For example, here, let's say we entered a buy on this double bottom. I did actually get an entry here based off an order block across here, but let's say we ended like this, and that was that. And then we see this order block here, so we're like, okay, we're going to sell here. So, but our buy take profit, let's say, is just at this high up here, and obviously this would be at the entry point. So at this point, we would have ended a risk-free trade. This will be break even, and this will be at break even. No matter what happens now, we secure at least, you know, whatever this is in profit. So that's 1,100 pips in profit, no matter what happens. So if price continues to go up, we only lose fees here, and we'll be stopped at break even. You can put stop loss slightly in profit, so you don't actually lose anything at all, and price continues to go in the direction we expected. Obviously we have a bullish bias, so that is what we're looking at in the scenario. If price continue to break down, I always tend to stick with my bias. So let's say in this scenario, if we go to the weekly, it's very bullish here, and this is the complex pullback we were talking about. Again, bullish. If price does come down here, very, very rarely will I ever hold, because my bias is bullish. So I would just take this sell. My sells take profit will be at break even on the buy, if that makes sense. So we'll lose nothing on the buy, and then we'll at least recover some of the profits from the sell. And that is the concept of hedging. So general rule of thumb, if you're not confident in your strategy, don't look at hedging. But if you are really confident and you are profitable already, please take a look at hedging, as it's a really good way to secure some profits as an alternative to taking more partials and trailing stop loss. You can do this instead. But hopefully you've enjoyed this short video. Make sure you leave a comment down below if this helped you, and please leave a comment on what you wish to see from us in the future on YouTube, as we are sort of running out of content. My name's been Ben. Thanks for watching. Please like and subscribe, and if you wish to join our trading group, link will be in the description down below. Other than that, I'll see you next time.